Hey, good morning, everybody, or good day, depending on where you're at. So my name is Rob. I'll be introducing and kicking off the live webinar this morning. Can somebody put a Y in the question box just to let me know that you can hear me? Very good. Thank you. Randy, you're always good at that. Appreciate it. Okay, well, anyway, we're going to have a pretty much a typical agenda for today. And just for those that are new here with us, the agenda is typically, we're going to go through the volatility report. Shane will be handling that for us first. And then what we'll do is we'll take questions that are in the chat box. So make sure that if you've got a question, and by the way, we want to make sure that we keep those questions to things having to do with trading and pairs. And so if you have a technical question around the software, I know we just had the launch of the 3.0, so we're getting some questions about that already. And so we might filter some of those in. But what we'd like to do too is to make sure that if you've got a pair that you'd like us to look at, make sure you give us your time frames and the currency pair. And what I mean by time frames, make sure you give us a trend direction or your larger time frame, and then your entry time frame that you're using with that. So when the boys get ready, they can go through that stuff with you. Anyway, I think that's everything. If you do have a question that doesn't get answered, you can always send it into support@tradeats.com, as well as any technical questions you have on the software. So with that, I think we're ready to kick it over to Shane. Shane, why don't you tell us about the volatility report?
All right, hello everyone. We are going to jump into the volatility report real quick and try and keep this one short and sweet. Wanted to address one thing on dollar CAD. So in it said long contingent on staying above threshold price, but I thought for those of you that looked at this, it had a little bit of a drop off earlier this morning. So I just wanted to take a second to kind of talk about what's going on with this. As of this drop off, that actually formed an origination point for a new master pattern here on the hour chart. So we're going to be seeing kind of the results of that playing out. We didn't have one up until now in the current range that it's in. So we formed one down here, pushed long, and now we've got a new range up here and new origination point for the master pattern. So go ahead and stick a line right there, and you'll see some interesting stuff happen with expand high and expand low right around this area. So that being said, on CAD, one thing to note on this is that the weekly chart, we still have 2 weeks of blue candles following a pretty large snap down to the short side. So there's probably going to be a good, the thinking behind the long market was that there's going to be a little bit of a retracement just going after that big push to the short side. But either way, just focus on what happens right around this. This is actually a master pattern origination as well, since we expanded low, expanded high, and then come back and we'll see what happens right around this expansion line. So in the case that we come down to it and get a bounce, then we'll, we could be looking to continue long, but otherwise if we go back down short, it could be the second half of another expand low, break through the bottom, and then continue in the trend. All right. So the next market was Australian and CAD. This one was a little bit of a disappointment, ended up going into another box after being put on the volatility report, which is not the intention at all. Thankfully, it's a pretty small box and we're still overall got lots of blue long candles. So we'll be just watching out on that. Either way, it's the first box that we've had, since March. So this is good that it's finally resetting. We've got kind of a new center line just to be able to, make new decisions off of. So this will be good once it breaks out, and it being such a small box means it'll probably happen sooner than later. So not much to report on this pair. And then the second one, or the third one, excuse me, New Zealand versus the dollar. That's when I actually went ahead, and this formed a master pattern origination point as well on the hour. So we can see we broke from the previous range, pushed down, and then price formed a new box right here. And then we had expand high, expand low, then back expand high, broke through the high, and then expand low. And then we reacted, bounced off of that origination point, expand low, and now we just finished the expand high right here. So we definitely want to pay attention and see if price continues up, because the logical progression of this, if this doesn't continue pushing high, then would be an expand low to go down through this low that was set previously. So we just want to see, how that reacts, and it's a lot of that's going to be dependent on how it reacts around this daily average price line, because as we all know, once we get a solid reaction off of a daily average price line, price can push in the same direction for weeks on end. So definitely want to pay attention to that. But either way, this is probably going to be one of the better pairs to trade throughout the rest of the week, granted that it doesn't form another box or do anything like that. So anyways, that is the volatility report. I'll be looking for any questions in there about this, and yeah, be following up on them. That being said, I'm going to hand it over to Wade. Thank you.
All right, thank you, Shane. I want to thank you guys for being on the webinar today. Give me a second. I'm going to get my stuff set up here so I can present to you guys. So give me a minute while I transfer everything over here. Hang on. Okay, so we should be up and running. Can you guys just let me know that you can hear me all right? Just type a Y in the chat. Let me know that I don't got any problems with my audio or anything before I get started here. All right, looks like we're coming through. And so, hey guys, I want to apologize for last week's webinar recording. I already saw a chat in here asking about, or someone asking about the recording. We sent out an email, but I'll just briefly touch on GoToWebinar. Literally, when we hit the start the webinar button, there's a automatically checked box that says record the webinar, and we make sure it's checked every single time, just like we did right now, and make sure that it's good to go. We hit the start the webinar button last week in expectation that the recording would automatically be done, and it literally was nowhere to be found. I don't know if it was a glitch in GoToWebinar system or what happened, but it literally, it usually starts rendering the recording immediately after we close the webinar down, and it just never happened. So, anyway, I apologize for, we try to make sure we archive all these webinars for you guys. So if you're wondering why last week's is missing, that's why. We did have that happen a long time ago. It's only happened like twice that I can remember in recent history, but anyway, I don't know what the deal was with that, but I apologize, and we'll hopefully we get everything okay. It's recording right now, so anyway, hopefully it works out. So you guys had some questions come in, and you guys can I'm going to take a look at some pairs for you guys right now. One question that came in regarding the expansion index. It was one of the first questions from Michelle. Appreciate your question. Just talking about generally how to use the expansion index. And for you guys that have recently loaded the new software, there is a tutorial video in there that talks about how to use the expansion index. It's pretty short, pretty sweet, pretty to the point. But you guys can go in there and look at that as well if you haven't already. But The expansion index, just to kind of cover it, in a nutshell, it's just in a nutshell, it's a measurement tool. That's all it is. You're trying to see what normals are happening as far as movement. And to give you a quick rundown of how it works, basically, when you get a new expansion line or an expansion dot with a line coming right after it, you're going to get a dot on the expansion index as well. And what these bars are doing these are, as you start, they'll start really small. But what they're doing is they're measuring how much movement you get above or below the expansion line. So it's going to show you how far the deviations are moving away and then it resets when you get another expansion. For this one, and one of the questions on there was, when you get one that has a situation like this where you have a little bit of yellow below and you have more blue above, or vice versa, it could be reversed. What does that mean? And what that means is that it's literally looking for price activity above and below this exact price level of this expansion. So this one, the reason why you have yellow below here is because of this wick right here on that candle. That wick showed you that there was some selling activity below that price level. However, obviously it was just a quick pull down in this immediate uptrend right here on the 4 hour. But that's what represents what happened right there. That's why you have that yellow, but you can see the predominant growth was to the upside. And that's why it showed blue there as well. And then you can see like this one, we got a new expansion dot here. You can see that it's only yellow because you could see when we got the dot, there was no price activity it was this candle that triggered it. There was no price activity above. Now, if this candle spiked up and went above right here, even a little bit, you'd see a little bit of blue. But that's it. It's just literally representing that price activity. Now, the question, well, why is this important? Why is it helpful? Why should I care what the expansion index does? What it does is that it's supposed to be showing you normals of expectation as far as how wide the market's opening up. One thing that you can, well, actually, I'll tell you about this in a second. Let me stick with this point. What it's just designed to do is you're supposed to be able to just take a quick glance over the expansion index and see, what is generally normal in how far a push is going to go. And are normals increasing or are they decreasing? And the average lines tell you when you are based on recent history that's part of the algorithm. It's telling you when you've basically kind of essentially knocked it out of the park when you're trading in trend. When you get above expansion, you're looking for a big trending move. When you start getting above that, you are out of the normals. And that's, so if you're in a trade, you should know, like let's just put it this way. When you are above, well above the average line, if you're looking to get into a trade, you need to know that, yeah, this is a bigger move than normal, but you are, this is something that it has expanded pretty heavily, and you should be careful. It just gives you a tool to measure it, to give to fuel your expectation of what the possibilities are with the market. You see, we had this one expanded high out of here, out of this average line. Then the following one expanded low and met the average line, and then see how it consolidated. We had this one didn't meet the average line. The next expansion it went under the previous, and all of a sudden they shrank down real low, right? So this point right here, which is actually if you want to call it the master pattern origination point, swing low, swing high, swing low, swing high, and then we took off. Right there, you can see that represented on the expansion index. See how the swing low, swing high start actually coming up. You have this one comes out, comes up, and then next thing you know, this one exceeds the previous yellow. Then it starts moving up. So you can actually start to see when you break those when it tightens up right here, you see that the volatility really shrinks. You're not getting hardly any expansion travel out of the market. That's your clue right there that, hey, this thing it's going to start to open up again. Remember, the market almost breathes like lungs. It contracts when you breathe out, and when you breathe in, it takes a breath. That's like when it moves and travels a distance. So it's always breathing, contracting, expanding like lungs. So when you see those contractions, and we have the boxes, we have those things, what after that is that you're going to get an expansion of volatility. unless everybody stops trading that market that has been trading it before, the volatility will stay in the box and get lower and lower and lower. But this is Forex. You would know that's not going to happen. So that's where our expectation comes in line, is how far, our moves into travel, and when are they going to expand? When is that volatility going to come into the market? And you have those markers on your chart. So going back to the expansion index, what this gives you is it gives you a general understanding of what is normal for how far a market is going to travel. For instance, if you were going to trade right here, you're in this move. Let me zoom in a little bit. So in this move right here, you can see we have the expansion. So pretend that you're here in the moment, right? And this hasn't happened yet. Right here, all you know is that your 4 hour is above expansion right here as you break out of the box, right? And let's say you're trading the 15-minute as an entry time frame. All you know right now is that your 4 hour is above expansion and you should be looking to trade long. And at that point, the expansion is very small. What you can do is that in that moment, you can look at the general swing of things, and you can see at that point, most of these have been within the average lines. So, but it'll give you just a general reference point. Another thing you could do is look at the previous buy expansion. You could say that if I'm looking to enter on the 15, ultimately you're looking for the 4 hour to follow through and travel in a trend. If the 4 hour doesn't travel in the trend, your 15-minute trade isn't going to work out. You got to have confidence in where the 4 hour is headed potentially to stick your 15-minute entry. So you can, if you're long and you got that brand new expansion, you can look at the previous blue bar, and this should be at least your expectation. If it's going to turn into anything significant, you need to at least beat this, right? So that's how you can use the expansion index. Same thing on the lower side. If you were trading right here lower, see how your previous expansion, it measured from this line all the way to, this was the bottom of it, this candle right here. So if you're trading short right here, boom, you pop an expansion. Now you're looking at, I got to at least get above here. And then once I get above there, let's see if we don't boost down. Then the next level's right here, and see if I could boost down to this average line. You're getting a sense for if it's performing. Now, if you take away the expansion index, you take that completely away, now you're sitting here with just monitoring the candles, and you're looking at the lows, the highs. You have some different things to look at, which also can help, but it's just designed to give you that extra measurement point where you can just kind of decide, what am I going to expect for the upcoming activity. So anyway, that's kind of the general way of how you use the expansion index. Hey guys, hang on 1 sec. I have to adjust something. 1 sec. I'll be back in about 10 seconds. Okay, sorry about that, guys. Okay, so let me see here. So anyway, so that's how you get the general sense of how the expansion index works. And then when the market opens up, when you're in trend, that's a good way to use it on your higher time frame. But let's talk about the entry time frame. So as the market runs, and right now it's kind of, you can see on your higher time frame, expansions are tightening up. You could see it in the market action as well, but you can see like this last blue up expansion didn't beat the last expansion here. So it's gonna push, but right now you got to be aware that the market is shrinking. And you may, if you're trading this one, you may want to wait till you exceed a more significant expansion, because that'll tell you, hey, guess what? There's enough volatility, there's enough market players, there's enough price action and movement in the market since I beat a previous bigger expansion that I could probably expect that the following expansions are going to have a little more follow through and movement to them. So as you see the expansion index opening up and exceeding those previous levels, then that's something where you can start getting more interested in your higher time frame. Because remember, at the end of the day, it's just about confidence in your higher time frame to follow through in trend. That's what gives you more confidence over here. So as that happens, then you can start, let's say that this really starts taking off to the long side and busts through here, as the market goes up, Then at how you'd be looking to use the expansion index on your lower time frame, if you want to use it there. Let me find a good trend here. So this is all the market kind of tightening up here, but this principles still apply here. So let's just take this downtrend right here, which was this movement right here. As you're trading that and you're looking for those entries above expansion, for instance, on this rotation, you're above expansion right here, taking the turn, trading it back towards your expansion line back through. One thing you can do is that this is the expansion dot for the 15-minute right here on that turn. You have that expansion. Remember, you're trying to just ride it into the average because it's measuring the movement away based on historical activity and volatility. You're basically trying to drive that expansion bar up through the average in trend on your lower time frame. And then as you get through that, you know, and you get down in this neighborhood, you're going to be looking at that expansion. And instead of just purely relying on the price action, you do have the liquidity lines to help you. But on top of those clues, you have this clue as well, showing you, hey, we've met, you know, this is a bigger than average movement. And if you're in it, you should probably think about taking those profits off the table because it's already, you know, way past the averages. You know, so it's just, again, it just keeps your mind in real time, keeps you thinking about what are the possibilities of the market. The biggest thing that it's trying to help you with is getting lost in your own thoughts and your own expectations based on how you feel, because how you feel and what you want the market to do, what I want it to do, what we all want it to do is not, it doesn't matter what we want it to do. What matters is what's actually happening. So it's just a tool to be able to discern and get us to be on the right, you know, page with what the realities are, and just make decisions in that way. So anyway, hopefully that's not too confusing. And you guys, you know, I get emails all the time for people seeing different things and finding other ways to use it. You guys, you know, you're gonna find your own way with it as well. This is just what I designed it for. Was just to keep your mind in the right place with expectation. I hate it when people get in trades. I hate it, you know, same with my experience. You get in a trade where you think, oh man, I'm really knocking this thing out of the park. And all of a sudden it turns around on you, and you give back half your profit or all of your profit. It makes 100% retracement back to your entry point. Well, if you have the expansion index, you can look at those previous expansion bars. You can see how much volatility is this market really showing, and then you can kind of keep your mind in the game of like, okay, yeah, I'm in the money on the trade, but you know, unless we get, you know, unless this thing shows some more action, we start beating some of these recent highs on the expansion index or recent lows, then you know, I'm going to smash and grab. It's smash and grab mode. So that's what it's supposed to be used for. One other thing you can look at too is that especially when you can define a sideways market, you're going to get, I've talked about it before, the expansion lines are the true center of gravity of market. They're the static. If you guys have ever studied mean reversion, things like that, or you know, just center of gravity in general, what it does, basically the methodology behind that is that price is always trying to find value, which is true. It's always trying to find true value and equalize. The expansion lines are the equalizing points of the market, and you can see going back and forth. Literally, when you're looking for set profit targets in a sideways market, you can almost just always trade back towards expansion. You know, how many times did you weave back and forth through these lines in a sideways market? Right here, bam. You know, it gravitates back, bam again. Right here, you're above expansion, comes back. Dip below expansion, comes back. Above expansion, comes back. Just as you deviate away from these things are like rubber bands. Price hates to get next to them. It gets repelled, but when it gets away from them, it snaps back like a rubber band. Especially the only difference is when you get in a trend, then we're trying to trade it only in trend with that higher time frame. But when you can see you're in a sideways market from the price action, you can also look at the expansions, and when they're not meeting the upper level, how far they're pushing. All of these expansions in a sideways market typically always come back to their origination, which is the expansion level. So like if you're in this trade right here it's pushing down below. Let's say you're trading this down on the 15-minute. Well, you're still not coming out of the normals. All of these are going to return to that mean, or until the trend finally breaks out on the higher time frame. So that's kind of I don't want to make you guys over trade or get too crazy on that. Trading the statistical approach like that, just trying to find price and value, trading towards center of gravity. But that is basically a strategy in itself, is just trading back to center of gravity on the expansion lines, just because price goes back, gravitates towards those levels over and over and over and over again. And essentially, the farther you deviate away from a relevant expansion line, you can expect that exact pip amount for the most part coming back to that center of gravity. So it's a good way to project an exact profit target. Now, the difficult part with that, before you guys get too excited about that, is that controlling risk. Because now what ends up happening is that you could end up putting in trades and then it travels further on you. And it typically will come back, but that's where you really got to judge the action of the environment. You got to judge what's going on your higher time frame. And you do have to have a good, way to get out in case a trend breaks out. Because you'll win, basically every single trade if you can define the trading range well, right up until the point that the trend kicks in. When that kicks in, you got to take the loss and then marry the one side of the trend. But you got, like I said, that's a more advanced approach. You guys got to be careful with it. Because it's in a situation like this, I'll just show you right here. We're going back and forth. You're winning every trade. Every trade, market tightens up. Got to watch those really tight points, because that means, okay, we could definitely explode here. Boom, now it takes off in a trend. Now, if you sold right here expecting to come back here, this is what I'm talking about. Market expanded, but it still did end up coming back right back to that level. So you still technically would have won that trade, but you got to be really careful on your risk management and think about those trades, because when that trend does break out, you don't want to sit there and be, going 100 pips negative, waiting. You got to be able to change with the market before, quickly. And you need to expect that if you are trading back and forth like that, that you're going to take a loss finding the trend. You better, have taken enough trades in the sideways period to justify the loss. So anyway, that's a more advanced approach. Just stick with trend. That's the safest if you're new. Stick with the basic strategy. But that is another way you could use ATS software, because you have those true centers of gravity. You have the measurement tool of the expansion index showing you the normals of deviation. Even a trade like this, we are still below. A trading ID on Euro USD right now could be if the 4-hour holds below this expansion. You can see we've pushed up. We've even went out of the normals. But if we don't get above this expansion on that 4-hour, guess what? You're going to deviate right back to this line, just like a rubber band. And you can see previously we pulled away. What happened to this expansion? Right back, like a rubber band. That's that returning to center of gravity. So, like I said, it's a whole strategy in itself, but I would only recommend experimenting with that with, first of all, low leverage. You do not want to be heavily leveraged on those. Just in case they do start traveling, you need to figure out it's a trend. You don't want to do that at a big lot size relative to your account size. And anyway, just got to be careful with that. Anyway, hopefully that kind of clears up some stuff on the expansion index. I'm going to take a look at some pairs here that some people asked for. I see that we got flooded with a bunch of questions.
I wanted to throw something in real quick. So as far as kind of the way that ATS works for those of you that are new, and it's always helpful just to kind of ground in some of the basics. But what Wade just said there is really important. So, the whole theory is that, I want to see it stay below that 4-hour average price line. So if price does end up staying below it, that's kind of, the premise of the trade. So you can manage your risk off of that point or right around it. So that would be how you manage getting into an entry, where you see a reaction to a line, and then you manage your entry and your risk off of that. And then that reaction to the line or the level is going to justify you getting into a trade and manage your risk. And then coming back, then your expectation is that price is going to rubber band back to a previous expansion line or another level, and then you can make the call in a progression as to when to get out of your trade. So right here would be a good example on euro yen. We're reacting to the second to last expansion line here on the daily. So if we get up above that and you see that there's a reaction and you think that it might turn off of it, then you can manage your risk right off that line, right off of that most recent expansion line. And the closer you get to it, the less risk you have, because that's what the premise is set up on of taking the trade in the first place to the short side.
Yeah, so that, that, like Shane says, it all comes down to risk management at the end of the day, for sure. And the expansion lines, those are the sensitive points of the market. So most important line you guys have on your screen is that those expansion lines. They give you the turning point as far as buying and selling activity. So, however you want to use that framework, you guys can use it for a number of different things and formulating different ideas. We give you the basic strategy to get your feet on the ground, but at the end of the day, this is the ATS system is not, it's not designed to be a rules-based system that where you guys just come in and you're like, follow this formula robotically. It's supposed to give you the real framework of the market so you guys can come up with creative opportunities based on your own risk management and things that you want to do. It's a map. It's the closest you're going to get to the insider's look into market liquidity and sensitive price levels, or a market maker's book of business. You're looking at from an eagle's view down at the market and understanding what the players are doing based on the contractions, expansions, and the sensitive price levels. How you use that information is up to you. You got to formulate a trading plan around it based on your pairs and things like that. But that's, at the end of the day, that's what this is supposed to be. It's supposed to be a creative platform that is, not just some average based, settings based indicator. This is like Fibonacci, 2.0 is what ATS is supposed to be. It's hard static levels that you can count on to figure out risk to reward ratios and come up with trading ideas. That's what it's supposed to be. So I'm going to take a look. I see a bunch of questions coming in. I'm going to try to get to those here, but I'm going to look at a few pairs for you guys. I'm going to try to do this kind of quickly so we can get through everything here. And for you guys that are new, we like to try to keep these usually around about an hour. Usually they go over a little bit, but that's usually what I know some of you guys are up, at like 2 a.m., 3 a.m. listening to this, depending on where you are in the world. So we try to be mindful of that. Euro yen day 1 4 hour from Phil asked me take a look at that. So I'm just going to give you my general kind of what I think's going on here. So let me take a look. You're in the day and the 4 hour. So if you're trading these right here, one thing I would do is always keep a bird's eye view on your higher time frames, even if you don't have them up. Just find out what they're doing. Okay, so your weekly's turning long on euro yen. Let's take a quick glance at the monthly. Okay, so we got a new expansion on the monthly. So we got some fresh things happening here on the higher time frames. One thing on the weekly, we'll go back to that, is that you've come up, we've expanded high on this. This had a chance to retrace back to the expansion here. And so this is showing a good sign, this first weekly candle, that we can potentially trend up. One thing I'd be looking at, because you want to look at the expansion lines all together, they all work together to build you, a full framework. You want to look at the one that you're dealing with in the moment, but you also want to take into consideration the ones that are in the range of where price is right now to give you kind of a understanding of what's going on. You can see right now that we are right at this previous expansion line, and this was respected by these wicks here. So it shows us this was, there's a more significant activity that could be happening at this exact level. So one thing I'd be looking at, if you're long on a euro yen and looking for a big trade to pan out to the long side, I would really look for a benchmark for the progression of this trade would be to get through the expansion line, this previous expansion line right here. I'd like to see that weekly push up and start holding above that line. We're not quite there yet, but if you're in a long trade right now, that's one thing that I would be, me personally, again, just my opinion. You guys do what you want, but that's one thing I'd be looking at to do. As far as entry, there wasn't really any straightforward entry for the most part. The only thing I can see if you were trying to get in, or if you bought, the only management point that I see is basically, this last expansion. See, we pushed down, we kind of had a reaction from this expansion in that general neighborhood, which is a good sign. Means we're starting to reject these previous expansion levels. That's a good sign for holding an uptrend. But at the end of the day, we really got to manage risk. You can see this expansion line here. So if we look at all these, this is probably the most relevant one to where price is right at this moment. So if you've bought this market, let's say off of this rotation, if you want a tight risk management, I would probably put your stop loss right below this level right here. So, probably right about here, and adjust your risk management based on that. And the expectation would be that we're at the pausing at this liquidity line level. I'd like to see us boost out of here, and attack this high up here. And if that doesn't happen, if it starts swimming sideways, personally, there's not a whole lot of architecture up here, and this is a 4-hour chart. So if you're trading a 4-hour chart, you got to be prepared to go 50 pips negative, on some of these trades. Just finding your trade placement. That's just the nature of trading these higher time frames. You're not always going to nail it. But anyway, I would really control your risk probably around this level if you're trading higher leverage. If you're kind of loose in the trade, ultimately, you get much below this level, the origination point, then, you got to start questioning if you're in a trend. Looking at the expansion index, again, kind of going with what I'm saying, this was the last blue push right here. So the market makers, the smart money, they showed this initiative before. Okay, they've already moved the market in the recent history this much. And you can see that this bar has not proceeded or exceeded this bar. So if this is going to be a move that you're expecting is going to turn into something in line with the weekly, all that looks good, then, you got to tell yourself reasonably, we need to exceed this high. And when you exceed this high on the expansion, if this keeps pushing up, once you get this high, you really want to see some fireworks start going off, in order to really say, yeah, this is a good trend that I want to hang in. If you get above this high and then the 4-hour starts going sideways and falling apart, I'd probably take your entry from here on the rotation up to around here somewhere, probably above this high, and just, wait for another opportunity, see what happens. But that, you see how that's another way you could use that expansion index, or it's the same way, just kind of reiterating, is that if you're in this, it's like, this is it, man. This is the horse you got to beat right here. And this is not based on us just, imposing our view on the market. This is measurable. The market moved. So however the money was flowing, whoever was making it flow proved right here that they moved it this many pips from the balance point. It's there. It's in history, can never be changed. So you have this proof that there is this much activity in the market ready to move. So that's, again, another benchmark. You can use that expansion index to come up with the expectation of what the potential is of any trade that you're in. So anyway, that's what I see on Euro Yen. Worst case, if this weekly is going to trend, you're definitely at least going to this high, which is how far away? Right now it's about 324 pips, 3,240 points away from the top. So if that's going to happen, and this is really going to climb, you're probably going to get through that, and you're probably going to get up to this expansion or even this expansion. This could easily turn into a 6-week long trend to the upside. But right now we're in the birth stages of this new trend, and you have the very basic things to work with to kind of evolve with the price action to see, is it behaving, according to your trade idea, or is it not? And that's it. All we can do is just monitor the market. We come up with an idea, we enter the trade, we monitor the market. It's either going to act for profit or it's going to act for loss. And we have the tools here on the dashboard to discern what that activity is, sooner than later. And that's all we're really trying to do. So that's what I think about Euro Yen. I'm going to take a look at Aussie USD. Okay, and this is from Andre. He's trading the 4-hour into the 15. So before I switch to the 4-hour, I'm gonna keep it on the weekly, and we'll talk about that. Change this to a 15-minute. Okay, so the weekly is long, but you guys see these last few weeks have been going kind of sideways, not much activity. It's no coincidence that we are right here with one of the proprietary expansion levels. Remember, I was talking about like a rubber band. Everybody thought that, you know, it was doom and gloom right here, you know, as the coronavirus stuff came out and everything, you know, and everything, all and this is not pertaining to Aussie USD, but I'm just talking in general, the Dow, everything, uh, you know, was tanking. The Dow especially was tanking. Everyone's freaked out. But at the end of the day, what's prevailing? His market dynamics. Look at you see this thing just cratered, and what happened? Snapped back like a rubber band right to here. That's what I'm talking about. The mean reversion, the statistical analysis of the market pulling away, coming back to center of gravity is the truth, man. That's what the market does. You know, we want to trade it in trend predominantly on the higher time frame, trading back towards those center of gravities, which is the basic strategy. But in general, this is the market behavior. Regardless of what the news is coming out, what's happening, people are going short right about here. This is where they think they're missing out if they're trading this pair. That, you know, they just can't take it anymore here. But what? Sucks right back up to the origination point right here. The insiders, they knew it was going short up here. It pushes down. You got the expansion, which is our warning. That's our warning that the insiders are bringing more volatility into the market. Volatility's coming in. We're below. Boom. Everyone else catches on about here. All the dumb money floods the market. The insiders sell, or they close out their trades them as they're selling. Insiders are buying. Right back up, closing those positions. Right back to the origination point. Nothing lasting really happened here yet. Now, I know the coronavirus stuff isn't totally over yet. There could be a lot more volatility coming with that. But point is, market dynamics came through, and that's the only thing that comes through. Because at the end of the day, the whole thing, Forex, market is just a sea of beliefs and opinions and emotions. And that's all it is, you know, and it's money, you know, flowing back and forth. So anyway, right now, come on, I didn't mean to get lost in that. Aussie USD weekly is going long. We're holding above expansion level right here. You know, I would stay long with the trend. You know, we're above this previous expansion, but right now it's really contingent. I would probably not monitor risk on a higher time frame going back to this one. I'd really look at what's happening. How is the weekly going to dance around this expansion level right here? Right here. That's really what I'd look for. So, but for right now purposes, we're long. That the candle's blue, so you know, let's say that this week is going to stay blue on there. So let's jump over the 4 hour and see what kind of architecture we got. Okay, so now we're pulling out above. You can see this 4 hours a representation of those weeks just getting kind of consolidated sideways. But right now we're blue. Last expansions, you can see these tiny ones. You have this last blue didn't exceed the blue, but now we're getting a little bit more boost above these last blues. This market's really tiny. But another thing, looking at just the general shrinking of the expansion, this is, you know, your warning before the market breaks out again. It's actually pretty, you know, basic breaking out of consolidation. So as of right now, you're long on the 4 hour, you're long on the weekly. This very well could break, but keep in mind that, you know, we have broke above these previous levels. You know, I would not be surprised in a market with this kind of activity that you would get a full retracement back. But so a lot of people, this is a big problem that they have, is they say, how do I know that, you know, the market, when I get a fresh breakout and I find an entry and all of a sudden the 4 hour just comes right back? Well, you have this measurement tool right here to help you discern if that's a possibility. But also too, you're supposed to use the lower time frame to help you predict the future of this. So this looks like it's headed for a box right here on the 15-minute. There's really no entry right now. The only place you could have entered, and this is more of an advanced entry, but as you push through this previous expansion level, see we got pushed through up here. You could have bought as you came through this and then monitored your risk based on being below, because the facts are, if a trend is really going to hold intact, it's going to start respecting these expansion levels. It's going to come down, it's going to hold above this level and continue the trend upward. So right now, this is probably the best place to monitor your risk from, in my opinion. Again, you guys make your own decisions, just my opinion. That's the best place to monitor your risk. But if you don't like that, if you're not in this trade, I would probably wait for a new box on the 15, wait to get some counter trend liquidity, let it come back, let that pullback come out, test this level, let this come to you, let it test this level, see a rotation, and then trade it long off of that. Work out that scenario if you're not already in, or wait till you get some tighter architecture. But right now, that's really all I see is definitely you want to be long with the trend, and you want to, I just look to manage your risk off of this point. And then your profit target, like I said, if this is going to hold on the expansion index, the next pillar you need to attack is right here. And that is basically representative of that high. That was the farthest push from this expansion dot, which is right here. So essentially you want to attack this high based on the expansion index and based on common sense of what the predominant highs or lows are. You have a liquidity line level here. So, I'd basically be working this gap from liquidity line to liquidity line if this holds. That would be a pretty conservative profit target. And if that does work out from where you are right now, just to the expansion levels, 48.4 pips. If you really attack the high, that's an 84 pip possible upside. So that's worth, waiting and working out what's going on here. But if you're already in the trade, best management point you got right here is right here, this level right here. I'd probably stick your stop loss a little below, because the facts are, if you come down through this level and it starts holding below this level, you got to ask yourself a question of, is this 4 hour just going to come back? Because if it comes back to here, it can come back down to here. We can have an expand low, expand high, expand low situation. You got to be prepared for those scenarios. We don't control it. We just have to react. Okay, so I'm going to take a look at USD CAD for Eric, a week into the 4 hour. And I think I've made my point on the expansion index stuff. So I'm going to try to go through these a little quicker and get to some of your guys' questions. Okay, so this one we're going to turn into a 4 hour. Okay, so what's going on here? Okay, so weekly is blue, and this is substantial. So you got to think about going back to like the multiple time frame video in the online course and the same one that's on YouTube. Weekly, you got to ask yourself, if you're trading a weekly, which is what Eric has said, he's trading USD CAD weekly into the 4 hour. Okay, so your follow through for your trades, if you're entering on the 4 hour, is based on the weekly staying the same color it is, or closing the same color, and surpassing the highs, which would be right here for blue, or surpassing the lows if it's a yellow candle. Just talking about this general situation. So right now you're blue. Right now we have dollar CAD pushing down short. And so this is probably, if you're using the 4 hour and the weekly on ATS Assistant, you probably just got a grade A or possibly a grade B signal. I don't know if one already triggered here, but either way, this is still fresh. So whether you got grade A or grade B, this is fresh to this rotation. Now here's the scenarios you got to weigh out looking at this. Number one, we are below this expansion level. So possibility is this could be a short breath in a downtrend headed back to here. Remember, the expansions are like rubber bands. We expanded away. There's a possibility we could rubber band right back to this level. And that may be the fulfillment at the end of the day of this. If this turns yellow, I would probably reverse your position from long and head down here as a profit target if this turns yellow, or at least through this low, get down here and then see what happens. Because then, there's a good chance it's just going to fulfill that return to the mean down here. Now, if you're long, it's all risk management. So let's figure out what's going on. So right now you're getting the signal. Look at the previous architecture. Right now we push down, we're holding at this previous expansion level, right? So before you just enter, look at the previous architecture in this overall area. I would be looking to get a reaction off of this level, would be nice to see if we get a reaction off there. See the 4 hour pull down, see it hold at this level, see it start shrinking back, then go long right there, and then control your risk under this level. I really wouldn't want to ride it. I wouldn't enter right here. You know, I mean, you can, but you need to adjust your money. That's why we have the money management lines. If you're trading, you know, low lot size, you can see that your if you buy, your risk for 1% is down here based on you know, and your guys' account. You need to adjust this for your account, but it's down here. So you can see that if you bought at this lot size, you know, and you had your money management lines spread this wide, they're well below this. So you can use that as a risk point down here and still maintain a good percentage, you know, profit or percentage risk. So that's a possibility, but look for your rotations, how you're going to enter this grade B or grade A signal, whichever it was. If you're using the assistant, then, you know, I would look at this as a reaction point right here. If you get through this one, then your next one would be down here. And put it this way: if you get much below this point right here, then this is probably going to turn yellow. If this turns yellow, then what happens to our scenario over here? It's probably rubber band action coming right back down to here. Probably. So at that point, if you buy right here, let's say you buy and you lose, you take a hit, you buy based on this expansion level, you lose right here, you get stopped out. Okay, what did we learn? We learned that this didn't hold. Why didn't it hold? If this didn't hold, what does that say about the trend on the weekly? It says it may be a little weak. Okay, now we're down to here. Maybe we give it one more chance, right? Now we lose again, and now it's down here. Now the weekly's yellow. Now this changes the whole scenario over here, you know, and then all of a sudden it pushes down. Now you're down here, and then you get a new box right here, and now you're getting a pull up back up to here, but now you got a yellow candle over here. That's a short opportunity to take it back down to here. So that would cause you to reverse the way you're looking at it. Again, these are just scenarios. I have zero idea what's going to happen. I would say based on Heiken Ashi candles, I would stick to the blue side as it's as the weekly's holding. I think there's a decent probability that you're going to hold at this level or this level and then turn back up and snap back to this mean. And that's the point of trading the strategy in trend. Is that, you know, right now you're below center of gravity, you're below the balance point, and your higher time frame is blue. So that's really, we're trading the probability that we got a deviation, a counter trend liquidity against the bigger power, and that we're going to come at least back to here. So that's your, you know, would be the original idea. But again, that's it. Those are your benchmarks. This is the first one. This is the second one. You get through there, the scenario changes. That's my take on that. So let's take a look at Aussie CAD. And if I can find it, there it is. Okay, oh, you know what? I wrote Aussie CAD, and the reason I did was, let me see here. Okay, so Shane, I think Shane brought up the Aussie CAD as part. It was right, Aussie CAD. Shane, can you tell me that was on the volatility report that you just went over, right?
Yes,
okay,
correct.
Yeah. Okay, and Shane had a box, and I'm in a box right now, and this is part of that. I've already covered this in previous webinars, but when you get really whippy tight markets on the candles, the boxes are affected by the close of a candle, and the color close has an effect on whether you get a box or where it is. So Shane, he has two boxes right here. I have one, and it's literally a difference in how the computer loads the price data. Even on the same brokerage, the same type of account, you can get slight variations in how the data is received based on your internet connection, all those types of things. And that can be because ATS is super price specific, and it's not an average based system, it's a static based system. You know, that gives you the hard levels. There can be slight variances in that. But going back to what Shane's screen, however you're working on this, we did have the box, we did break out on the volatility report, and it is still, we're in a box and we're in this contraction zone, so it will break here soon. But what I wanted to say is that the predominant trend, what I was noticing, I wanted to bring up, is still long. So if you guys were looking at and kind of confused about that volatility report, however you're looking at it, you know, I think that this thing is definitely about to break. And if you are in a situation where it went into a box, like shown on the volatility report, I would still hold long based on the benchmark Shane's set forth, staying above the average price line. Or if your screen varies a little bit, just go off your architecture. Just go off. You should have, even if it's slightly different, it should be a very similar enough where everyone should come to the same conclusion, for the most part. So just stick with what's on your screen there. And if you're ever confused about a sideways market, then back out of it. Look at the higher time frames to get some real understanding of where the trend is. Because at the end of the day, it's just about staying in trend with that. So anyway, I'm going to go through some of your guys' questions. Shane, if you got anything you want to bring up about any of that, feel free. I'm going to take about 2-3 minutes and do some reading here. So hang on, guys.
Yeah, just to add to Wade's point, when if the market builds a little bit slightly differently on whichever data feed you're using from whatever broker, on my example, I was using IG to make the report, so it ended up looking a little bit different there. Anyways, I kind of liken it to a map made out of dotted lines. If you're missing a dot, you still have you still know that it's a line overall. So, we've seen a lot of people's charts and everything, and usually it's 99% the same. And, if price is in contraction, you're going to get a box at that level and taking it all in. And as you guys all know, it's not one single line that makes or breaks the whole thing. It's all of them working together. So you'll still get the same reactions, and it will be similar enough on all data feeds to, like Wade said, come to the same conclusion.
Yep. So I got a few questions here that I wanted. So one question I wanted to address was regarding the trending phase from Joe. And this is probably the biggest question that people ask on YouTube and stuff is like, I see, how do I know when the market's in the trending phase? The facts are is that you have to trade the expansion phase to find the trend. And the way that you understand if it's turning into the trend or it's going to hold or not is through the lower time frame. If you want to wait to see if the trending phase already happened, then the trending phase already happened. So you have to trade in and around the expansions and manage risk, and you have to sometimes buy clues to figure that out. But essentially, if you're looking for situations where you want a confirmation, like you want to know, I talk about on the master pattern video, price settling. Everyone asks, how do I know when price settles? How do I know, the facts are is that there's some situations where the market just breaks. When you're above expansion, you just got to get in and you got to manage your risk accordingly. If you guys want to know when price settles, you wait. It's an answer. The same question is the answer to the question poses the answer. You wait till price settles. You wait till you have an expansion. You have a new expansion line. It rejects the expansion line, and then you trade that first rotation. And so you're going to say, well, what about the ones that just break? Well, if you don't want to manage risk on the lower time frame, you don't trade those. I don't know what else to tell you. But that's it. Everyone wants to know, how do I know price is settled? You let it settle. Let it settle. Let the next rotation come to you, and then you should be in for a more significant push on the trending phase. And then you can manage your trade, on your longer time frame in and around that. But that's how you know. You know when price settles when it settles. Same thing here. Expand up, price comes down, gets rejected off the expansion. It's settled. Now feel free to trade this leg. Same thing right here. Price broke, deviated all the way back, all the way up through. Price pulls back, rejects off the line, price settles. Trade right here. So that's always a question. And I probably just need to do a video on that. But everyone's like, how do I know when it settles? You guys are trying to find opportunity. The biggest thing with new traders is that you guys are getting up, you're getting on the screen, and you're trying to find opportunity in everything. There's movement, and you got to get it somehow. What you guys got to be careful with is that the opportunities that are really only workable and consistent are opportunities that you understand and opportunities that you can effectively engage with. So, looking for price settling, just wait till it's clear as day. If that's your strategy, that's your approach, if that's something that you understand, then trade in that scenario. If that scenario hasn't clearly presented itself to you, then don't trade. Other than that, when you break out, you can have some monster moves that just break right out of contraction. The definition of expansion is leaving contraction. And expansion can turn immediately into a trend if it's a significant enough move. And that's also, you can determine the potentials of what a box can do by looking at the overall framework. In a situation where a box just breaks right here like this, why did this just break? Well, you're breaking, you have these expand high, expand low points, the range is opening up. That's a possibility. If you were waiting for price to break out of here and come back, kiss the line, and then turn down, it's not always going to happen. And that's the point of figuring out the future of your higher time frame on your lower time frame while simultaneously looking for a good entry. That's why you manage the minor expansions within the 4 hour the higher time frame candle. So that's, if you have a scenario that you want to trade, you want to wait for price to settle, let it settle, let it rotate, then trade. Same thing right here. It happens quite often. Expand high, come back, kiss the line, boom. There it is. There's your tradable leg right there. You can do that. Same thing right here. Come up, come through the line, boom. There it is, another leg. So it does happen. It's not going to happen 100% of the time, but if you need that to wrap your brain around something that's manageable, then let it happen. Nobody's holding a gun to your head. Nobody's making you pull the trigger. Just let something that's recognizable come to you and you deal with it. That's really just the way it goes. So another one from Rick, good question, adding to position. I've covered this a number of times, but adding to a position like in trend, if you're trading, say on the 15-minute, the question is, should you start with a smaller position size and then layer in as the trade goes in your favor? The answer to that is, yeah, it's up to you guys. I don't get into money and managing risk. I'm going to leave that up to you guys. The point of what we do here is to give you a good trading tool, and you guys learn the art and science of how you want to engage with it. We're just here to give you a solid piece of software that you can use to formulate good trading ideas. What I will say is, you guys, I didn't make this rule up. You don't want to over leverage yourself. That's just a common, well-known thing. So, but if it's, I would say, like breaking up your positions based on entering the market, I would break up your position based on how certain you are of the opportunity and based on how tight you are with the architecture of the market. If you're looking at a previous expansion level for your risk management and you're real tight with that line, then you can probably risk more. If you're far away from it and you feel like, oh, there could be some travel with this, then don't risk as much. It's really up to you, and I would just have a percentage cap. That's why we have the new management lines. If you're not feeling super confident about an entry, leave these things wide. Give yourself some room. That way you can trade, 1% positions and you can apply multiple layers of positions in there. It gives you that freedom. And it's just, like I said, it's just based on your experience and your certainty. The biggest problem, or one of the biggest problems that traders face, is choking out a trade, because you're trying to make so much, you're trying to make such a heavy percentage off of every little opportunity that you're always running super tight stop losses. If that's a problem for you, leverage down, keep your money management lines wide, and give yourself the freedom, and the ability to let the market build you some framework. Even if it goes against you 30 pips, if you're at a low lot size, you're probably going to get a new box soon. It's probably going to react off of previous expansion lines and then give you more information. Whereas if you're trying to manage every trade off of like, a 10 pip range, you're going to get stopped out over and over and over again. Especially if you're new and you don't have a lot of experience. Now, if you're trading lower time frames, you could do that, like a 5-minute chart. Things like that, you're getting in, that's a much more aggressive way to trade. But like I said, if you're just less experienced, chances are most of your trades, based on the fact of how market comes back to the white lines, center of gravity, your trade's going to be in the money at some point. Going back to the pain and pleasure concept, you open a trade anywhere in the market, and there's probably 90, since the markets range about 95% of the time, typically, there's a good chance you could open a buy or sell trade at any given point, and that trade will be in the money at some point, and it'll be out of the money at some point. What matters is when you actually close it. And most people close the trades when they're out of the money because they want the pain to stop immediately, right? So if you guys leave your money management lines wide with a low percentage, now you've got all the time in the world to think through what's happening. Now you're not just focused on, is the trade in my favor, is it not? Your pain threshold isn't tight. Your pain threshold is wide. And you're open to creativity and figuring it out, what you want to do. If the trade goes a little bit against you, but you see there's some framework lower in the market or higher in the market, depending on the trend, well, then you can add to the position. You got freedom. It's not make it or break it. Build the position, have fun with it. See what the market does. Let the story unfold. And the only way you can do that in a low stress way is by having good money management rules and not, banking everything on one trade. Now, the opposite of that is like the grade A type opportunities. Those are designed for someone that's more experienced to find, that has experience watching the price action with the software to take a grade A opportunity and lever up on it, because they know trend's either going to pull off or it's not. And those are those decision points. And you're going to know pretty quickly whether the grade A is going to work or not. But if it works, you have the potential to knock it out of the park at a high leverage. So that's another strategy you could use. But anyway, like I said, it's the system is designed to give you guys the flexibility to do what works for you and learn along the way. If you're gonna layer in position, the one thing about going back to Rick's question is that when you're layering in positions, number one, you want to do it like your normal position. Let's just say you guys are trading like one standard lot on Euro USD. It's like $10 a pip, and that's a comfortable position. But let's say the opportunity you're not that super comfortable with, break it into like three positions or four positions, instead, or trade $3 a pip, and put in one trade, see how it is. If it goes against you, but you still feel good about it, put in another 3. And then if it turns off that, now it's going in your favor, put in another 3 and build your position in that range. But don't build a position. What you don't want to do is layer into a bad trade. When the trade has your trading idea has been proved wrong, it's come out of the framework that you've defined as this is where it needs to behave within these parameters, and it's gone out of that. However you've decided to come up with that trading idea, that's where you stop layering in. When it's gone out of that box, that price zone, and it's proved your idea wrong, you do not add to that position, because you no longer have the fundamental idea intact to manage the trade. So that's just the thought process and things that you guys need to work out according to what you're trying to do. So all right, I'm gonna take probably 1 or 2 more questions. Shane, if you want to add anything to that, feel free, and then we'll probably wrap it up here. Okay, someone asked, let me see here if I could look at DE30. So I'm gonna take a look at that real quick here. So no time frame is mentioned, but I'll take a glance at it. Do some quick top down. Okay, so weekly's in a box. So if a weekly's in a box, good news is there's, in 2-3 weeks, this thing's gonna hit and have some big swings. But right now you're in a box. And if you look at the 4-hour, you can see that reflected. Tightening up, expansion index, not a whole lot of great activity happening on that, tightening up. So just my general observation on the higher time frames, 4-hour into the weekly, and even you gotta think about it, if the weekly's tightening up, if you're going to have big trending days, you need to have a weekly that's willing or open for movement. And right now it's showing consolidation. It's showing that tightening of the market. So if the weekly is getting tighter, I wouldn't expect your days to get much bigger. Let's put it that way. So again, adjust your expectations for what's possible. When the weekly opens up, now you can open up your expectations of what's going to happen on a day-by-day basis. Okay, so that's kind of my general. And then the 4 hour, I'd say the 4 hour right now, I could tell you that this has not been great. But one thing I will tell you, the weekly candle is long. It's blue at least. So we could work towards the high of the box and there could be a decent move inside of that. You're above expansion right here. Looking at the expansion index, you just got this dot on the 4 hour. So you look at what's the last pillar you need to beat would be right here. It's essentially that high. You got a liquidity line there as well. So, if you're going to trade, I would, trade very conservatively. There's just not there's not a huge swing in this market right now. I personally, just my opinion, would wait till the weekly breaks. I'd start getting interested in that as soon as you break the high or low of the box. And then that those following weeks, that'll probably be a good tradable market for the next, few months as it swings around. And then if the weekly is trending and moving around with a heavy volatility, then that'll transpire down into the days. And when the days are trending, that transpires down into the 4 hour and the hour, which then transpires down into the 15 and the 5 minute. If you don't have no swing, you got no opportunity. So let the swing hit, let the expansion hit, and then you guys will have something that's actually tradable. One question I'm going to address right now while I got this, you may ask if you guys pull up higher time frames, where is the indicator broken on the expansion index? Why do I not have the blue boxes and all that? The facts are is that we do need, in order to get the averages, we do need so much data history on that, and some of the platforms just don't go that far back with the data. Anyway, that's why you'll still get the expansions, you'll still get the bars, but you won't get the overall averages unless you have enough history data for it to get an accurate read of what the volatility averages are. So that's what that's about. So Blake put a question in about, could you explain the expand high, expand low? There probably two or three webinars back, Blake. If you go back and look at those, I covered it quite extensively. So I'm not sure which one it is, but if you go into the recent history, we've spent quite a bit of time talking about that. You could research those. Okay, guys, I'm going to find one more question. Shane, if you got anything else you want to cover, go for it.
Yeah, there was one thing. This one was a little bit more technical, just since we went through the update not too long ago. For any of you guys that are having the issue where your chart is expanding to full screen after switching out your pairs or making any changes to MetaTrader with ATS 3.0, it's a really odd way to fix it that's going to be addressed in the next bug, so it's not a problem. But the way to fix it is bring up a new chart through File, New Chart, add any indicator that you want to it, and then resave that as your default template, or just resave ATS 3.0 as your default template. But it's that default template, the default.tpl, that causes the issue for some kind of unknown reason. Anyways, it'll be addressed on the amendment that we make to it, the 3.1 that's going to be coming out here pretty shortly. But anyways, for now, just go in and resave ATS 3.0 or another chart as your default template, and it should get rid of the problem.
All right, I'm gonna take a look at one more market. We're gonna look at US 30. Let me see here. One hour into the daily. Okay, so daily is kind of in that sweet spot. US 30, I'll tell you right now, and it's no surprise because they're talking about another shutdown possibly happening for this virus situation, which I'm not going to go into too much, but that's going to create volatility. So this run up, there's an interesting opportunity happening right here. I would say if this starts, coming apart right here and holding below, just my opinion, I think this may be a pretty good short opportunity. Again, risk management, I have no idea if it's going to, follow through or not. But at the end of the day, you got to come up with an opinion and you'll either be wrong or right, but you just need to be more right than wrong. And your wrongs need to be small. So if we hold below the expansion line right here and get a rotate short, this could be a pretty significant down move. And I would say at least back down to the expansion level down here. I think we could cover that range, and that'll probably transpire over the next few weeks to a month, depending on how all this stuff goes. But then again, if they flush more bailout money into the economy and more economic stimulus payments and all that stuff, then they may inflate it back up to here, and back up to all-time highs is another possibility. But whatever we do, you're going to see, you guys don't need to pay attention to all those fundamental things. What without knowing any of that, the fundamentals, why this is opening up out of the daily right now, just not only just because of trading volume, but because of, they're waiting to see is there's a lot of things that the government's trying to work out right now. But without knowing anything about those fundamentals, just from a technical standpoint, we've broken out of the box. That institutions are now entering the market. They're about to start opening this thing up. That's what we know on the daily time frame. This is the decision point right here, that expansion level for long or for short. If you get above, you trade the daily long. You get below, you trade it short. My opinion right now, I feel like could be a turn to the downside, especially because everyone was buying up right here. I think we're going to at least get a retracement down to this level. This was, everybody was thinking, oh, we're on to a full recovery, that there's not going to be any repercussions for shutting down the world for 2-3 months. I don't think it's, I think it's not over yet. So, if that's not over, we're probably headed down to here, and we're possibly headed down to here, which that'll get a little interesting down there, economic wise. But that's it. Institutions they're getting ready for the play right now. But again, you guys don't need to follow fundamentals. All you need to know is institutions are in, they're ready to start making moves. This is their decision point line right here, whether they take it long or short. And that's all you need to know from a technical standpoint. Right now you're long on the daily. If you're trading right here, you could trade with expectation you're going to come up. Your first entry opportunity on the 1 hour would have been this rotation right here. However, you're still holding below. I would really expect that if you get much below this low of this candle, if you're trading this long, I'd be careful, going back that, because if you get below this, you're probably going to rubber band back to this level right here. And I wouldn't be willing to risk, to lose from here to here. Not in this situation. So that's one thing. And notice you also are holding the architecture from back here. So right here, you come up, you're holding below that line. So that could also be a clue that we're going to turn short as well. So this is kind of at a decision point. If you're long, I would wait for it to break out. If you get above here, then I would hold that position, because you're probably going to the high and back up to here. If we hold below, I would wait for the daily to rotate, find another entry down in this neighborhood based on new architecture or maybe the old architecture, and then ride that thing down. Because I think if we do rotate, you're at least probably coming down to here, which could be, a decent move. So that's it. Just come up with a scenario, figure out your risk management points. You guys have the tools to do it. You have the static levels. This stuff never changes. It's the same every day, same formulas, same calculations. The settings don't change. Wait till an opportunity comes along that makes sense, formulate a trading plan around it, and then execute. If you win, great. If you don't, reevaluate, figure out what the information is that you just bought and paid for, figure out how to use that information to come up with your next trading idea. Because typically if you lose, you're paying for the information to win. if you're doing it right. So I'm gonna leave you guys with that. Thank you guys so much for being on. Really appreciate it. If I didn't get to your questions, if you guys are new, feel free to always send in your questions to support@TradeATS, and we're more than happy to help you as much as we can there. We want you guys to do well. We want you to stay on the platform for a long time. So we'll do whatever we can to help you guys and coach you guys through email and help you out. So anyway, thank you guys so much. Really appreciate it. And we will see you guys on the next webinar. Thank you.